Am I audible? Is the screen visible? Hey, team, can I get a confirmation? Just a moment. Yeah. So, good morning. Welcome all to day 2 of revision. As I said in day 1, we'll be going through certain theory and then we'll be solving topics. We'll be solving questions, right? Those of you who are watching this for the first time, I request you to please watch day 1, where we discuss certain exam tips. My name is Prajitosh Panchal, and let's begin for the day, right? So today we'll be looking at CAPM and betas. Now this, whatever I've written in this presentation is just taken from the ACCA Study Hub. Okay. Sorry. I have a bad cough, so pardon me, please. Yeah, I was talking about this presentation being taken from the ACCA Study Hub. I personally recommend using that as the single source for learning. Okay, since it's from the institute, I think it's the most reliable source to depend on. Right? So, investment risk. Now, risk, as we all know, is extremely sorry. Risk, as we all know, is variability. Okay, any fluctuation like standard deviation is a measure of risk, variance is a measure of risk. There's something known as beta, which we are going to do shortly, is a measure of risk, right? So any movement is risk. For example, we say cryptocurrencies are risky. Why do we say so? Because a cryptocurrency could move either direction. It could go up, it could go up or down 10%, 5%, 20% in a day, and it's considered normal. The share market, on the other hand, the stock may go, or the index may go, or the large cap stocks may go maybe 1 or 2% on an average on a daily basis. And if there are certain huge events, then they would fluctuate a little more, like say 5% or something of those sorts. But a 10% fluctuation in a stock is not very common. In fact, in countries like India, you have filters, circuits, okay, which will prevent the stock moving beyond a certain percentage, right? That is not the case in cryptocurrencies. Cryptocurrencies 10% move in a day, pretty simple, very common. But large cap stocks, not so common. So large cap stocks are considered less risky, whereas cryptocurrency would be considered as more risky. Okay, that's how we look at risk, volatility, variability, right? Now, how do we determine returns? So there's a popular saying, higher the risk, higher the return. So if cryptocurrency has higher risk, why do people still continue to invest in cryptocurrencies and trade these currencies? It's because they are chasing higher returns. So the moment you look at returns, you need to ask yourself the question that what is the risk involved? Unfortunately, a lot of us only chase returns and we do not look at the risk aspect of it, right? So you must also look at risk, and CAPM, or capital asset pricing model, helps you find out the cost of equity considering risk. See, in cost of equity, we learned two methods in ACCA. Okay, firstly, we won't be discussing these topics in in-depth details. Okay, what we are going to do is, this is like a quick revision of sorts, right? Because we don't really have the time to discuss these topics in detail. right? This is going to be a 2-hour session wherein probably half an hour or an hour we'll spend behind the theory, and then balance we'll do it in problem solving, right? So yeah, as I was saying, that there are two methods to in ACCA wherein how we calculate your cost of equity. Number one is the dividend valuation model (DVM), which is taking dividends into consideration and discounting those, or rather, yeah, that's to find the price. But you could use the DVM also to find the cost of equity by rearranging the formula. Okay. Then you have CAPM. Now in DVM, they are not typically looking at risk per se. They are not considering risk as such. They're just looking at dividends, and indirectly dividends are influenced by the risk. Okay. Now, because if the company takes high risk, the company earns higher returns, and therefore is in a position to distribute higher returns, or the shareholders would just demand higher dividends because they are taking additional risk. However, CAPM very categorically considers risk. Within the formula, there's something known as beta, which is a measure of systematic risk. Now, why systematic risk? Right? So firstly, there are two major types of risk. One is systematic risk, one is unsystematic risk. Unsystematic risk is, as the word suggests, is unsystematic. It is unique to the company. Whereas systematic risk is that risk which is built into the system, which is known as market risk. It affects everyone. Say, for example, Corona. It affected all industries across the board, though in varying degrees, but it did affect everyone. Like, for example, the pharma industry may not be that affected by Corona as compared to an auto industry, right? Corona hits, people were trying to save up, they were not purchasing vehicle, there was lockdown. So auto industry very badly hit. But pharma industry or FMCG industry, your essentials, your utilities, okay, they were not that much affected because people continued consuming the same level of medicine, the same level of groceries. Okay, so but there were certain bottlenecks with regards to the supply. Okay, so what happened was Corona as an event affected every industry, but not different, but differently. Okay, to some different degree. Some got impacted more, some got impacted less. This is an example of systematic risk. It was a risk or an event that affected the entire system, the entire industry, the entire market, right? The other risk is unsystematic risk, which is unique to the company. Say, for example, the company's factory caught fire. That is going to affect only that particular company. Okay. Or certain top level management person quit the company for prematurely quits the company. There was no succession plan or anything before completing his term. He quits for whatever reasons, right? That is unsystematic. Some scam or something, some unethical practice that has surfaced, some allegations on the company. Unsystematic risk affects only one company, not the entire market, right? A quarter of poor sales affects only that company. Therefore, the earning forecasts have been impacted. Share prices come down. So this is unsystematic risk. Now, unsystematic risk can be diversified. Say, for example, in your portfolio, you have 10 companies, right? Maybe one company, or you have 20 companies. So maybe one or two companies are facing some problem with them. Okay. And they are fluctuating more. as compared. Okay, one more thing. See, when we speak about risk, we not only refer to the downside, we also refer to the upside. So unsystematic risk could also mean that if something that has become super favorable for a particular company, okay, bumper sales or bumper profits, or raw material of a particular product that they are using, as they are importing, or they need to manufacture their goods, that prices have come down. So it's affecting only that company and probably its peers, but not the market as a whole, right? So these could be your unsystematic risk. And so a easy filter: unsystematic risk, unique to the company or not. Okay, does it impact only this company, or does it impact the entire market, right? So um, if you have a portfolio, like say you have a portfolio of 20 stocks, then you are not impacted by those one-offs, okay, you're not impacted by those unsystematic risks because you have diversified your risk. Why do we hold a diversified portfolio? To diversify the risk. So we have stocks belonging to, probably you are doing diversification across industries. So you have one or two pharma stocks, you have one or two FMCG stocks, you have one or two auto stocks, you have one or two banking related stocks, you have one or two tech stocks, and that's how you're creating your portfolio. So you have a diverse, you have exposure to a variety of industries, right? So you're diversifying your unsystematic risk. So what you are affected by is systematic risk alone. And this is the base assumption on which CAPM is built on. That base assumption CAPM model makes is that the shareholder has a diversified portfolio, and therefore he needs to be compensated only and only for systematic risk. And therefore, in the formula, we consider only beta, which is a measure of systematic risk that affects the entire markets, right? Now, what is this beta? Beta, as we said, is a measure of systematic risk. How do we calculate? Now, calculating beta is extremely sorry about that. Okay, I was talking about beta. So I was saying that calculation of beta is not really in the scope of ACCA, but just to give you a working understanding of beta, how do we calculate beta, or how do we interpret beta? If your stock, say for example, you are looking at the beta of Apple, and say if it is 1.2, right? What does 1.2 beta mean for Apple? It basically translates into, if the index, that is the market, moves 1% in either direction, up or down, Apple is expected to move by 1.2% up or down. Okay, in the same, it's directly related. If markets go up 1%, Apple stock is expected to go up 1.2%. Remember, expected to go up. Does that mean that it will go up? No, not necessarily. It's just that in the past 6 months or 1 year, there is a general observation that whenever the index or the market has moved up 1%, Apple has moved up 1.2%. So that's how we arrive at beta. Okay. It basically measures the volatility, or it measures the fluctuation or the variability in the share price with respect to the variability in in the price of the index or the markets. Okay. So say for example, if the index is Nasdaq 100, then if Nasdaq 100 moves up 1%, Apple is expected to move up by 1.2%. Okay. So that way you have defensive stocks, aggressive stocks, and you have neutral stocks. Defensive stocks are typically your utilities and pharma companies, which basically, see medicines or say electricity. Okay, you would just consume whatever is required. You wouldn't consume that, if you have excess money, it's not like you're going to consume more of it, or if you have shortage of money, you will consume less of it. Say, for example, a toothpaste. It's not like if you are rich, you brush your teeth more often. If you're poor, you brush your teeth less. No, do it twice a day, and that's all you require. So these are usually defensive stocks. They don't move much. Okay, they move little less. So usually their beta is less than 1. Neutral is around 1 or equal to 1. That's a neutral. It moves in tandem with the markets. And then aggressive stocks are more risky stocks. For example, I guess Tesla would have a beta more than 1, which basically translates to, if, say, for example, if your beta is 2, then if the market moves up 1%, then your stock is expected to move up by 2%. Or if the market falls by 1%, the stock is expected to move down by 2%. Okay, that's the meaning of beta. And then we use this beta in the CAPM model, which is your measure of risk. So considering the systematic risk, you arrive at the expected return of the shareholder. See, understand, whenever we look at cost of capital, the two terms we use interchangeably is returns and cost. Okay, we use them very interchangeably, wherein we say that cost of capital is equal to the expected return of the shareholder. Now, you may wonder that how is cost and returns equal to each other? Well, it's from the point of view of two different companies. Two different parties. So if you think from a company's point of view, for the company, it is a cost. For the investor, it is the return. So from a shareholder's point of view, he's expecting a certain return. From the company's point of view, they have to pay that. Right? So it is a cost for the company. I'll give you a very simple example in terms of a loan. Okay. If the bank takes a loan, it has to pay interest. So that's the cost for the bank. That's the cost of loan for the bank. Sorry, a cost of loan for the company. The company has to pay interest to the bank. The bank is receiving the interest. So from the point of view of the bank, it is a return. So in this case, bank is the provider of funds. The company is the borrower, or the party which is utilizing the funds. So from the company's point of view, it is a cost. From the banker's point of view, it is a return. However, in case of debt, always remember, when we look at company's point of view, we always consider post-tax cost of debt, because we enjoy as a company, interest is tax deductible, interest expense is tax deductible. So if you are incurring a certain interest, that is going to reduce your profits, thereby reducing the total tax that you pay. Okay, but from a banker's point of view, they are not going to receive any such tax benefit. So for them, they are going to say, for example, if you have taken a loan of 10%, you pay 10%, but against that 10% interest that you paid, you say, for example, get 30% tax benefit. 30% is the tax rate, so you get that as benefit. So net, you are kind of paying 7%. It's like 10% is an outflow, and then 30% you are saving on that outflow. So net outflow will be 7%. Okay. However, when you think from a bank's point of view, the bank is receiving the entire 10% as interest. Okay, so from a bank's return point of view or a yield point of view, the bank will say my returns is 10%. But the company will say my cost of this loan is 7% and not 10% because of tax benefits. Okay, the tax shield that the company would enjoy. Right? But in case of equity, that's not the case. In case of equity, your cost of equity is equal to the expected return. So when we find the expected return of the shareholder, we are basically finding the cost of equity, which you can use in WACC, which in turn can be used to discount future cash flows, and arrive at NPV. Right? So let's just go through it. I explain the entire thing in brief. Let us just read through now. So, uncertainty or variability of an investment return is investment risk. The amount of risk an investment has depends on the variability of returns around the average return, often measured by standard deviation of return. So, higher the risk, higher the return is what we uh, expect. And how is high risk measured? When your variability is high. Investors are assumed to be risk averse, which means that we assume investors don't like risk. Okay, they don't want risk. They try to be away from risk. Investors in general will seek to maximize return in relation to unavoidable risk. This is referred to as mean variance efficiency and is used in the derivation of CAPM. Okay, so in CAPM, it is assumed that they want to maximize their return, okay, on unavoidable risk. So what is avoidable? That is diversifiable risk that they will diversify, the unsystematic risk. So what they're trying to say is, in general, what investors try to do is they try to maximize their returns and minimize their risk. Okay, so we assume that they want to minimize their risk. So therefore, we assume that they hold a portfolio of stock and diversify those unsystematic risk away. Right? CAPM was developed in the 1960s as a part of modern portfolio theory, which states that each investment has varying amount of unsystematic or unique risk, which can be diversified away. Because such risks are uncorrelated, that is good and bad news from the companies with differing positive and negative exposures to an unsystematic risk will cancel out each other. Okay, so if you have say 20 stocks, a few stocks will be doing extremely well, a few stocks would be doing extremely unwell, and a few stocks are moving as per the market. So net they kind of like cancel out each other. The extremely well doing stocks will get cancelled out against the profits that you make in those stocks will get cancelled out against the stocks which are doing poorly, and you kind of get the average return. So therefore it is often said it's very, very difficult to beat the index on a consistent basis, right? So for example, if the price of copper rises, share prices in copper mining companies will rise, but the price of shares in manufacturing companies would fall. Okay, so few stocks which are copper miners, they are benefited, so they go up. However, it gets offset or cancelled out by those companies for whom copper is a raw material, right? Systematic or market risk which cannot be diversified away. For example, both the copper mining company and the manufacturer will be exposed to interest rate risk and the state of general economy. Okay, if there is inflation, both will get impacted. If there is deflation, both will get impacted. If interest rates go up, both will get impacted. If interest rates will go down, both the companies will get impacted. So portfolio of shares has a total risk that is made up of these two types of risk. As more different shares are added to the portfolio, the unsystematic risk is diversified away, and the amount of total risk reduces to approach systematic risk only. So, if you see this diagram over here, initially, okay, this is on your x axis, you have the number of stocks or number of securities that you hold in the portfolio. And on the y-axis is your total risk, which is a summation of systematic and unsystematic risk. So initially, when you have lesser number of stocks, say you have one stock or two stocks, okay, you can see that systematic risk is this much, and then the balance is all unsystematic risk. And as you increase the number of stocks that you hold, the unsystematic risk is getting diversified and it comes down. Okay, eventually, once you have around 20 stock portfolio, you kind of bring down your unsystematic risk to almost zero, and all you are left with is systematic risk. So your total risk is almost equal to your systematic risk. Okay, unsystematic risk becomes zero. So what you need to be compensated for, therefore, is only systematic risk. This means that investors should only be rewarded for risk they cannot avoid, that is systematic risk. Just because a company has high total risk does not mean it will require high returns. For example, a company seeking to discover and mine gold. So what they are implying is, just because the systematic and unsystematic risk together is very high for a particular company does not necessarily mean that that company will give you a high return. Okay, for example, company seeking to discover and mine gold, a gold exploration company may have a very high risk, but most of that risk can be diversified away by investing in several gold exploration companies. And this diversification is achieved by investing in different business sectors, uh, or also you could just invest in different companies, right? So it depends. Like, in fact, you could even diversify using different asset classes. A little bit of debt, a little bit of equity. Within equity, you could do diversification across industries. Okay. Gold mining companies, coal miners, power generators, auto, BFSI, that is banking and financial institutions, insurance, a variety of sectors that you could diversify across, or else you could have, like, say, IT or gold exploration, and within that, you have 10 different companies and you have invested in all 10 of them. Okay. So, as I was saying, diversification is often achieved by investing in different business sectors, but as this example shows, some risk can be diversified by investing in several companies within the same sector as well. Because the company specific risk element of total risk can be diversified away, the investors will only be rewarded for systematic risk. The systematic risk of gold exploration company reflects how the profits of the company change with the change in state of economy, okay, the overall economy. The price of gold is not well correlated with the state of the general economy and often rises during the times of crisis. So, gold exploration companies' profits are also not correlated with the state of general economy. The company will have a small amount of systematic risk. The corresponding required rate of return on gold exploration is therefore likely to be low. Okay. So the systematic risk of a gold exploration company may be low, and therefore the compensation, that is the return that you will get for such a company, would also be low. Now, as I said, beta, we discussed measure of systematic risk. Different shares have different systematic risk, which are measured by beta. A supermarket chain will have a low beta because people always buy food regardless of the state of economy. But a mobile phone company will have higher beta because during recession, people will delay buying new mobile phones. Recession, when people do not have a lot of money, they are not demanding a lot of goods, they don't have much spending power. So they will, with their limited money that they have, will spend on the essentials and not on luxury products. Right? So they may not necessarily buy the most expensive phones. They may need, because in this day and age, phones have become a necessity, unfortunately. But they may not necessarily buy the pro models, but they would buy probably the base models. Right? Um, Beta is equal to systematic risk of investment I compared to market and therefore amount of premium needed. Beta is a measure of systematic risk of an individual financial asset. For a typical share, beta lies between 0.2 and 1.6. If if the beta is zero, it basically means that it's a risk-free instrument. Okay, so if the systematic beta is zero, the return that you will get is a risk-free return, RF. If the beta is 1, that means it's a neutral share and you will get market returns. Return which is equal to the index or the markets, RM. If the share is defensive, that is the beta is less than 1, in that case, the returns that you are going to get, since the risk is less than the markets, the return also you will get is less than the markets. So you will get returns between risk-free rate and market rate. You won't get more than market rate. Okay, and if your stock is aggressive, that is, it has a beta more than 1, then you are expecting to get returns more than what the index or the market is giving you. Okay, why do you expect more? Because you are taking risk more than the market. So beta 1 is basically average risk, market risk. If you are taking above market risk, beta more than 1, you are expecting above market returns. If you are taking below market risk, then you are expecting below market returns. However, you are taking some risk, so more than risk-free rate. Okay. The market return is the return on the market portfolio. That is a fully diversified portfolio with a representative sample of all traded shares. Then you have the SML, that is the security market line, shows the relationship between systematic risk as measured by beta and the required return. Okay, so if you take more risk, more return is required. So it's like a linear line. ERM, or expected market return, is the expected required return of the market portfolio M, any share with a return above SML. Okay, so if you see company A over here, this is your risk-free rate. Okay, then so risk-free rate is like, it won't be a sloping line, it's just this way. This line is your SML line, that is, it increases because on your x-axis you have your systematic risk, on the y-axis you have your expected market returns. So more risk increases, more returns you are expecting. Okay. So yeah, sorry, I was talking about company A. So company A is above that SML. That means it's giving above market returns. All right. And if you see company B, it is giving below that SML line. Now, what is going to happen is everybody who looks at A will start buying A because everybody knows it's giving greater returns, okay, more than SML. So they will buy and the prices will increase, and then eventually it will start giving SML returns. Okay. Similarly, for company B, everybody will sell because it's giving below that SML line. So everybody will sell it, and then the prices fall, and then eventually the return will be in line with SML. So any share with return above SML will be sought after. This will drive up its prices and hence reduce its expected return until it earns only the required return as indicated by SML. Any share with a return below the SML, for example, B, will be sold, and this will drive down the prices and hence increase the expected return until it earns the required return indicated by SML. The CAPM formula is the equation of SML is given in the exam as capital asset pricing model. ERI, or expected return on investment I, or KE, is cost of equity, is equal to risk-free rate plus beta into market premium, or RM minus RF. Okay. Now, just understand this, that when we say that if somebody asks you, okay, what sort of returns are you expecting on investing in Apple? Okay, so you will say, firstly, I need my risk-free rate. Since I'm investing in stocks, stocks are risky, has some degree of risk. So I need minimum, I need is risk-free rate. Now, what is the risk-free rate? Whatever your government bonds are giving as yield. Okay, so say, for example, if the government bond is giving 5% yield, then you will say minimum I want is 5%. Okay. Then you will say, but I am investing in the share. So that means I want more than 5%. So how much more? So firstly, you start off with risk-free rate RF plus, then you will say, I want market premium. Okay. That is, at least I want that extra that the market is giving. So say, for example, if the market is giving 11%, okay, the NASDAQ 100 is giving 11%, right? So you will say market returns is 11% RM but the risk-free rate is 5%. So RM minus RF, the excess, the premium that the market is giving is 6%, right? So you will say, not only do I want that 5%, but I also want that 6%. However, I am taking slightly more risk than the markets. I'm not taking market risk. I'm taking a little more risk than the market. So I need to be compensated more. How much more? You are taking, say, your beta is 1.2. So then you will do 1.2 into 6%. That is 7.2%. So then you will say, I need 5 plus 7.2, okay, is equal to 12.2%. So therefore, you will then expect around 12.2% return from Apple shares. So that is your ERI, or also known as cost of equity from the company's point of view. Okay, so KE is cost of equity, RF is your risk-free rate, BI is your beta of the stock I or investment, RM minus RF is your equity premium. So now in the exam, okay, just keep a watch on what data is given. Have they given you market premium or have they given you market returns? Because market return is RM. Market premium is RM minus RF. Okay, so if you are given market premium and in a hurry you just take that premium and do minus RF, then your answer is going to go wrong. Okay, so that's why in day one I kept repeating that read the question properly. Understand what information is given. Do not assume that, oh, okay, some market return or market something is given. So we have RF, we have beta. The other variable left is market premium. So let me just take it as a whole. What if you are given market returns? Then you are supposed to do RM minus RF, right? So let us look at this example. CAPM can be used as an alternative to DVM to estimate a company's cost of equity. So if the equity beta is estimated to be 1.2 and the risk-free rate is 3%, then estimate the cost of equity of the company if market premium is 5%. So keep in mind here the word uses market risk premium. So it's RM minus RF. Okay. And the expected return on market portfolio is 9%. So this is RM, market returns. Okay, so your risk-free rate remains the same 3%. Your beta remains the same 1.2. Only in one case it is RM minus RF, that is premium is given, and the other one only market return is given. So in that case, we have to do 9 minus 3 and put it in the formula and get your answer. Simple. Assumptions of CAPM. Now, as I said in day one, that if you are writing a big report and you may want to highlight the assumptions that you are inherently making by using certain models. So if you are using CAPM model, you could not necessarily write all the assumptions, but you could write the main assumption that about the portfolio or diversified portfolio. Okay, you could talk about what we are going to speak about risk adjustments, that is taking proxy betas. Okay, so let's just read through this. What are the assumptions of CAPM? Capital markets are informationally efficient. Okay, so it assumes a efficient market. That is, all information about shares have been incorporated in the current share price. This means investors are rational. Investors is freely available. Sorry, information is freely available at zero cost. Transaction costs are zero. Corporate and personal taxes are the same. There's a sufficient depth of market that the prices are transparent. Depth means sufficient number of buyers and sellers in the market. Okay, we call it the market depth, right? So these are the base assumptions, as in for an efficient market, which is assumed by CAPM. Another assumption they make is investors are able to borrow and lend at the risk-free rate. Another assumption they make is market is mean variance efficient, which means that investors are risk averse and seek investments with minimum risk at their chosen level of return or the maximum return at their chosen level of risk. Just a moment, the lights just dropped. Is it proper? Yeah. Okay. However, some investors buy lottery tickets, a market that is clearly not mean variance efficient. Okay, so as we discussed earlier, mean variance efficient, they are trying to minimize their risk and maximize their returns. Why? Because they are risk averse. Okay, that is another assumption. Just a moment. There's some problem with the light. Just give me a minute. Okay. It is possible to construct a fully diversified portfolio and the investor has a diversified portfolio. That is, this assumption ignores the reality that there are many class of assets beyond just shares like bonds, property, fine art, antiques, and that some assets are personal and cannot be traded affect the investor's exposure to risk. The following, okay. So just keep that in mind that it assumes mean variance efficient. Sorry, the market is mean variance efficient, and they try to the shareholders have a diversified portfolio. What follows is the things that is challenging that, right? Like they are saying that in reality, maybe not all investors are diversified. Okay, they may have like just one or two shares, and then they have maybe a huge real estate. Okay, they must have invested there, so they are not diversified within the markets. Okay, or they could just have a personal business. It's a closely held company, so it's a family run business. In that case, they don't have like portfolio of stocks, they just have one stock or one company where they have invested almost 100% of their wealth in. Okay. Limitations of CAPM. The following are limitations on the usefulness of CAPM. The variables used by the model. Okay. Beta keeps changing every now and then. Your risk-free rate keeps changing. Market returns keeps changing. Okay. So the variables used itself are changing frequently, and therefore your cost of equity will also change accordingly. Beta values which are measured are using historical data. So we assume that they may remain stable, but it's not necessarily the case. The market premium for risk remains stable over time, which again may not necessarily be true. A risk-free security exists, that is, short-term government debt is usually used, but is it really risk-free? Typically, we like to believe or we take government securities as risk-free, but there is always some probability of default from the government's end as well. Okay. And lack of data for the model, for example, when using CAPM to find the required return for an unlisted company. Okay, see, as I told you, beta is found out by comparing market returns with your share price. Okay, but if you are not a listed player, then you don't have a readily available share price. Then how do you calculate it? Okay, so you can't, you don't have a beta. So then you would have to take proxy beta. Also, if your business risk changes, you have to take proxy beta. Okay, is a proxy that is a similar listed company available to estimate a beta equity, and are such similar companies sufficiently similar or not, right? So that's one important limitation, you could say, that the proxy beta that we take is of a similar company, but is it really similar? Is it same? It's just an estimated beta that we are taking. Okay. All company shareholders are assumed to hold well diversified portfolios. However, because it is not possible to be fully diversified, there are other factors, not just beta, that determine the required returns on the share. Okay. So now CAPM takes only systematic risk, but there are various other risks. Okay. Inflation related risk, currency related risk, right? Interest rate related risk. So many other risks are also there. So there could be like multiple betas. This particular beta is calculating systematic risk of the market. Okay. So all of the company shareholders are assumed to hold well diversified portfolio. However, it is not possible to be fully diversified because there are other factors as well that determine the required return on the share. Empirical research has identified the following small but statistically significant anomalies between the real world and the CAPM prediction. Returns on high PE companies are lower than predicted. Okay, so if, say, for example, the PE of a company is high, so therefore we would also say that the risk possibly of this company is also high. But in such a case, when we use CAPM, we find out that the returns are not as high as the CAPM model says. Okay, and the returns are actually lower than what is predicted. See, high PE. Now, why do we give high PE to a company? Because we are expecting high growth from that company. Okay. And basically, now, if the growth is high, the risk is also high. There could be volatility. Okay. It could grow at 1,000%. It could lower by, like, say, or 100%, 200%, 300%. Huge variability are possible. Okay, and therefore we are saying that return should be much higher. But in reality, returns of high PE companies may not necessarily be as high as we expect them to be. Then next point is smaller company returns are higher than predicted. So we are underestimating it and we expect lower returns, but these smaller companies are able to give you higher returns than as forecasted or expected. High beta companies have lower returns and low beta companies have higher returns than predicted. So it is not always the case that, oh, beta historically was 1.2, so going ahead also it will give that sort of returns. No, betas can change. That was one limitation. Therefore, that results in that high beta company means high risk company. High risk company should give high returns, but it could give lower returns also. Okay. So that is one other limitation, the real world linkage with CAPM predictions. Research also shows that market exhibits momentum, that is, shares with excess returns compared to CAPM tend to continue to exhibit excess return and vice versa for underperforming shares. So momentum is basically, as the word suggests, if the share is already in an upward movement, there is a possibility that it will continue this upward movement. Okay, often those who are investing in the markets, you would realize that, oh, the share has already gone up 100%. How much more can it go? And you are surprised that it has moved another 100%. You would hear analysts saying that, oh, the valuations are not sustainable, the valuations have become too high. But despite that, the share price keeps going up. That's momentum effect. And if shares are coming down, the momentum is downward momentum, the share just continues to fall despite certain value investors saying, oh, the price is become very cheap and we should buy. But despite that, it falls another 50%. Okay. So this is momentum, which again is in conflict with what CAPM would say. Because CAPM would say that, okay, expected return is 30% or 20%. Okay, but this stock, since it's in momentum, will give you more than 20%. CAPM is an approximation and not a foolproof method. Like any tool, it has its own limitations. Okay, right? One of the most important limitation is the user, that is a human being subject to behavioral problems explored by behavioral finance. CAPM is overly simple should be used with caution in real world. Okay, nonetheless, we still use it. Okay, it is better than CAPM at least. Shareholders in unquoted companies may not hold diversified portfolio. So in the question, you need to understand that whether this company would have, is it quoted or is it unquoted? Quoted or unquoted means listed or unlisted. If it is unlisted, basically means we can assume that it is held by the family or it's closely held. Okay, less number of investors, and they have invested majority of their wealth in that one stock. Okay, so shareholders in unquoted companies may not hold diversified portfolio. For example, a large portion of their wealth may be invested in this single family owned company. In this case, shareholders may benefit if the company diversifies across different projects to reduce the unsystematic risk. And financial managers in large quoted companies are unlikely to benefit shareholders by diversifying operations to reduce risk. Okay, so what happens is, just a moment. Yeah, what happens is that, see, if you, the CAPM model assumes that the shareholders have diversified portfolios, so you need to compensate them only for uh, non-diversifiable risk, that is systematic risk. Okay, which means that the company need not diversify. Okay, say if there is a company doing, um, say if they are selling instant food. Okay, they need not diversify and start selling, say, t-shirts, or diversify and start selling shampoos, or diversify and start selling anything else. Okay, like if you see PepsiCo, you would be like, PepsiCo will sell you soft drinks like aerated beverages. It also serves you juices. Tropicana is a brand of PepsiCo. They would also serve you, I think Lay's is also a brand of PepsiCo. Okay, a lot of different uh, sectors that they have diversified into. If you look at Nestle, Nestle has also diversified. They are into dairy, they are into chocolates, confectionaries, they are into several other things, those health drinks. Okay, like I think Nesquik or, Nestle has its own health drink. Okay, they are into milkshakes. They're into various different sectors. They have diversified themselves. They are into coffee. Okay, Nescafe. A lot of things Nestle is into, right? So basically, the company has diversified. Now, what CAPM model says that company diversifying does not achieve anything because the investor is already diversified. The investor has already invested in a coffee company. The investor is already invested in a chocolate making, a chocolatier, or a confectionery company. The investor has already invested in a dairy company. Already has a diversified portfolio. Whatever diversification the investor wanted to do, whatever sector the investor was interested in, has already been diversified into and has already been invested into. Company need not do it. However, for unlisted companies especially, the investor may not hold a diversified portfolio, and therefore they would want the company to diversify. Therefore, they kind of indirectly have diversified. So financial managers in a large quoted company, listed company, are unlikely to benefit shareholders by diversifying operation to reduce risk, because for large listed companies, we assume that the majority of the investors have diversified portfolios. Basically, they are institutional investors. They are in institutions like pension funds, or institutions like mutual funds or hedge funds. Okay, they already have a diversified portfolio. They are already doing, taking measures to reduce their risk. It is cheaper and easier for shareholders to maintain a diversified portfolio of shares than it is for the company to maintain a diversified portfolio of projects. See, from a shareholder's point of view, if you have to diversify your portfolio, you could just buy 10 stocks. It's simple for you. For a company's point of view, if they want to diversify into another industry or a sector, they would need to hire people, so many people who are skilled in that particular sector. So it's expensive for the company. Most shares in quoted companies are held by institutional investors. For example, fund managers. Such professional investors usually hold a diversified portfolio. That is, they have already removed unsystematic risk through the fund's diversification. Therefore, the implication of CAPM for financial manager of quoted companies are that the company should specialize and not diversify, and needs to compensate shareholders only for the systematic risk they face. The beta value for companies reflects both business risk as well as financial risk. That is, results. Business risk is a result from operations. How much fixed costs do you have in your operating costs? And finance risk resulting from their level of gearing. That is, how much debt do you have? How much fixed cost do you have in your cost of funding or cost of capital? Okay, debt is a fixed cost, right? So this beta has two other risks built into it. One is called the business risk, that is operation related, and one is called the financial risk, that is your debt related or capital structure related. Okay. Now, equity beta or the geared beta is what we use in the formula. Okay. When we take BE, we refer to beta equity or geared beta. That is, equity beta is made up of business and financial risk. Now, say for example, you do not have, like, say you are an unquoted company, you do not have your own beta. You are taking the industry beta, or you are taking a competitor's beta who is of a similar size of. Now, your business risk is same. However, your debt to equity, your capital structures will be different. Say you manufacture coffee. Okay. And there is another coffee manufacturing company. Your risks are same. That is, your business risk is same. But that company is having a debt to equity of 2:1, whereas you have zero debt. So your finance risk is lower, but your business risk is same. Now, equity beta, if you take the equity beta of that company, it is a result or it is a function of both business and finance risk. So you have to ungear it. You have to remove the financial impact and just have business risk. That is known as asset beta, okay, or ungeared beta. So an equity beta or geared beta is the beta of a share in a company as it reflects the systematic business risk as well as the financial risk of that share. It is influenced by the company's gearing. When used in CAPM, an equity beta gives you the cost of equity. Okay. But we would need the asset beta if we are taking a proxy beta. Proxy means a substitute beta. You don't have your own beta, so you're taking a substitute through some other beta. Either industry beta, like you could take coffee industry as a whole, or you could target one particular company who is of a similar size of you, or in similar location as you, or similar market share as you enjoy. So an asset beta or an ungeared beta is a measure of only systematic business risk of a company or share. Okay, so equity beta is business risk plus financial risk. Asset beta is only business risk. So business in the same industry are usually assumed to have the same systematic business risk, so the same asset beta. So what is same between you and your proxy will be asset beta. And this again is assumed. See, the same industry are usually assumed to have the same systematic business risk. So this is another assumption we make when we are using proxy betas. So when used in CAPM, an asset beta gives KEI, that is the cost of equity in an ungeared company, that is zero debt, fully equity financed company. So we will have to re-gear it. So an asset beta is therefore called as ungeared beta. It can be found by the process of ungearing an equity beta. So now this formula is given in the exam, so you need not worry about learning this. But it is similar to the formula of WACC if you look at it. Okay, it's value of equity divided by value of equity plus debt 1 minus T into beta equity. plus value of debt 1 minus t divided by value of equity plus value of debt 1 minus t into beta of debt. Now we assume that beta of debt, that BD that you see over here, is 0. Okay, this is beta of debt is 0. Therefore, the second half of the formula disappears and you just end up using beta asset is equal to value of equity divided by value of equity plus value of debt 1 minus t into beta equity. That's it. Okay. M&M viewed a company's business risk as shared between equity and debt investors. Hence, the asset beta is the weighted average of equity beta as well as debt beta. However, beta of debt is often assumed to be 0 because of the low risk of being a debt holder. So, this equation often simplifies to only the first half. Okay, so if let's look at an example. Acron produces electronic components but is considering venturing into manufacture of computers. Ungeared Acron is ungeared with an equity beta of 0.8. Now, so see, if you look at it, the company was making electronic components and now is going to begin manufacturing computers. Okay, so the business has changed. Now, Acron is ungeared with an equity beta of 0.8. That means Acron is debt free and it has an equity beta of 0.8. And the average beta of computer manufacturers is 1.4 and the average gearing is 1.4. So now we have the proxy beta of computer manufacturers, which happens to be 1.4, and we also have a proxy gearing ratio or average gearing ratio of 1:4. Risk-free rate, that is RF, is 5%. Market return, this is not premium, it is market return. So it is RM. You will have to do 12 minus 5. Okay. Its market return is 12% and the company tax rate is 33%. Right? So calculate the discount rate Acron should use to appraise a computer manufacturing project, assuming that it is to remain an all equity finance company. So it's asking you to find out the asset beta. Asset beta is the beta of an all equity finance company, zero debt. Okay. Remove all financial risk. Okay. So then you will just take the proxy equity beta. Now this 1.4 reflects both financial risk and business risk. Okay, so we have to remove that financial aspect and come only with business risk. Okay, so we have to ungear it. So we have the debt equity ratio with us. So when we say 1:4, so yeah, when we say 1:4, so 1 is your debt and 4 is your equity. Okay. So BA, so this is the formula that you will use, value of equity divided by value of equity plus value of debt 1 minus T into beta equity. So you have beta equity 1.4, value of equity is 4, value of debt is 1. Okay, 1 minus T, T is 33%, so 1 minus T is 0.67%. Or sorry, 67%, or you could also write it as 0.67. Okay, so therefore you arrive at asset beta of 1.2. They have asked you for the discount rate. That means the cost of equity or expected return. So just use in the CAPM model, risk-free rate plus beta asset. Why are we using beta asset? Because it's all equity finance, zero debt. Otherwise, we will use equity beta if there was gearing. Okay, so since there is no debt, therefore we could continue using 1.2 as beta into RM minus RF, that is 12 minus 5%, is equal to 13.4%. So on an average, we are expecting 13.4% returns. Risk adjusted discount rate, a company's existing WACC is only the appropriate discount rate for a project if that project has the same level of business risk as the company's existing activities. If the project has a different business risk, for example, in a different industry or country, the discount rate to reflect the business risk of that project is required. One approach, okay, I won't read through all these things. I'll just explain it probably if there is a question. Yeah. Okay. So now see, we had to use a proxy beta. Okay, even if we had, like, if you see, see, if you read the question, Acron already has its own beta of 0.8. then why couldn't we use 0.8 in the CAPM model and continue with it? Because the business risk has changed. Old business risk was electronic components. New business risk includes manufacturing of computers also. Okay, so therefore, suppose now this is the follow-up question. Suppose Acron from the previous activity has a gearing ratio of 1:2. So now your old beta is 0.8 and your new gearing and old, this thing, what do you say? Old gearing was 0, but now there is a gearing of 1:2. Okay, it still wishes to enter into the same computer manufacturing project. Okay, so we already had asset beta. We took the proxy beta. So step number 1, identify proxy beta. Always understand this proxy beta is usually equity beta. How can you find out whether it's equity beta or asset beta? Very simple. That proxy beta, you have to check what is the proxy capital structure or debt to equity. Okay, if there is debt, that means it is equity beta. If there is no debt, then it is asset beta. Okay, if there is zero debt for the proxy, then it is asset beta. But in this case, we saw that the proxy has a gearing of 1:4. Okay, so 1 debt, 4 equity. And according to that ratio, we will ungear the proxy beta of 1.4 and arrive at asset beta of 1.2. Then using the same formula, we are going to re-gear the beta. Okay, that is now we have asset beta 1.2, but we don't know our own equity beta, but we do know our own gearing ratio. That is 1:2. 2 being equity, 1 being debt. We call it debt to equity, right? So 1 is debt and 2 is equity. Now using that, formula remains the same, but just in this time, we don't know beta equity. We know beta asset from the previous step. So this is called re-gearing and this upper half is called ungearing. So step number 1, identify the proxy beta. If the proxy beta is an equity beta because it has some gearing ratio, okay, then in that case we find asset beta by ungearing. Then we re-gear with our company's new gearing ratio, okay, and arrive at uh, equity beta of our company. Using that equity beta, we put it in your cost of equity calculation and we arrive at the new cost of equity, that is 16.2% in this case. Okay. Now they have written a note that in the absence of any other information, assume that pre-tax cost of debt is 5%, that is risk-free rate. So discounting rate will be, so we have taken what do you say, your cost of equity is 16.2. Now here there is no information about tax or anything of that sort. Okay, but if there is, we could consider that. Okay, so I think we'll stop here, right? We'll take a quick 5 minutes break and then move on to questions. 5 to 10 minutes break we'll take and then move on to questions. All right. All right, welcome back. What's up with the light? Just a moment. Okay. Let me just check if everything is not overlapping anything. Just a moment. This I may be slightly, right? Okay. So I think here I'll just shrink it then. Yep. All right. So in fact, I can zoom in a little more, I guess now. Just let me know if I'm covering anything. Okay. Um, so as we said earlier that we'll be doing some questions now. Section B style. So those are 25-mark questions. Now, these are certain instruction. This section of the exam contains 2 questions. Each question is worth 25 and is compulsory. The exam section is worth 50 marks in total. You must indicate which requirement each of your response relate to. So that is clear for the markers, which means you have to write solution 1A, 1B, 2B, 3C, whatever. Okay. Show all working or notes that you want the marker to see within your response. Remember, any notes, workings made on a scratch pad or on your working paper will not be marked. Okay, so if you write anything on your scratch pad or if you have some pieces of paper, if the center has permitted you to carry a piece of paper, whatever you do over there is not going to be assessed. The following exhibits available on the left hand side of the screen. So when you access your CB platform, you will find that there are certain information on the left, okay, and then there's certain information on the top right, okay, and the bottom or half of the screen is where you type in your answers. So show all notes workings that you want. Yeah, okay, we read that. The following exhibits available on the left hand side of the screen provides information relevant to the question. That is Colvin Company project information, discount rate. This information should be used to answer questions requirement within your chosen response option. Okay, so these are like certain standard instructions that will be given. Okay. Now, let us start off by first reading requirements so we get a sense as to what the question is asking us. Evaluate the suitability of investment proposal in Canvia, including the impact of the country risk premium on the NPV of the project. So we have to do some investment appraisal in Canvia. And there's certain something about country risk premium. We'll know more about it, but at least we know that it is a NPV related question, so we can approach the question in that manner. Discuss the validity of the chief executive's reason for adjusting the discount rate used in appraising the project in Canvia. So this is something, it's a descriptive style of question. So 14 marks is calculation and 6 marks is a theory question wherein they are asking or they are asking for reasons for adjusting a certain discount rate. So probably some risk related adjusting is being done. We'll read that. And professional marks will be awarded for the demonstration of skills in commercial acumen, analysis, skepticism, and evaluation in your answer. Okay, so all this we have discussed earlier: analysis and evaluation, skepticism, and commercial acumen. Analysis and evaluation is nothing but doing all your calculations based on the answers given and drawing relevant conclusions. Skepticism is challenging certain information given. Commercial acumen is looking at it from a real world's lens, that is this practically even possible. Okay, so let's read the question now. Exhibit 1: Colvin Company is based in the Eurozone region and was established 10 years ago to manufacture competition standard bicycle for professional road racers. When the company obtained a listing 5 years ago, the founder retained a small minority shareholding. The remaining shares are held by a number of institutional investors. Okay, so information that we get from this paragraph is we are a Eurozone based company. It's a 10-year-old company. It is a listed company, manufactures bicycles for professional racers. 5 years ago, it obtained the listing, and the founder is the minority shareholder, but the majority of the shareholders are institutional investors having diversified portfolios. The board recently decided to expand the range of models and to look for new growth opportunities abroad. While manufacturing is currently restricted to the Eurozone, the board of directors has identified Canvia as a key growth market and is considering a potential investment project to manufacture and sell a new model there. This would involve establishing a subsidiary in Canvia. So they are expanding. Now, are they moving into a new sector altogether? No, right? They will continue selling the same cycles that they are manufacturing or selling in the Eurozone in Canvia. They have identified Canvia as a potential market. So business risk per se is not changing over here, right? Exhibit 2. So this was a little exhibit 1 was about the company. So you get to know the company and you could write you can understand things better. So the two key takeaways that you can take from this paragraph is number one, that it's listed, therefore listed and majority shareholders are institutional investors. That means they have diversified portfolios. So company need not diversify. And fortunately, the company isn't diversifying either. They just plan to sell the same products in a different country. They are diversifying, but into a different country, not a different product per se. So there would maybe be a new risk relating to the company, but business risk at least would kind of remain the same. Currently in Canvia is the Canvian Lira CL, and the current exchange rate is 9.91 CL per euro. So that's the foreign currency. Our home currency is euro. The annual rate of inflation in Canvia is expected to remain at 10% throughout the 4-year duration of the project. So this is one here you can be a skeptic and challenge that how can inflation be constant? Okay, it's an assumption. You can challenge it. Okay, the finance director establishes the project's sales volume, inflation adjusted, pre-tax contribution and cash flows are as follows. Okay, before we read that, another thing over here is with these inflation rates, okay, the fixed inflation rate for the next 4 years, we can project or forecast the future exchange rate, okay, using IRPT, right? Now, yeah, so they have given us the sales volume. They have given us pre-tax contribution. What is contribution? Contribution is nothing but correct sales minus variable costs. Okay, so sales minus variable costs is your contribution, and then you have your fixed costs. Now these are pre-tax contributions, and everything is inflation adjusted. That means these are already nominal. Okay, the project will require an immediate investment of $75 million in land and building and another $700 million in plant and machinery. So total investment is $775 million. The tax allowable depreciation is available on plant and machinery on a SLM basis at an annual rate of 25% on cost. Okay, so only they have spoken about plant and machinery depreciation. So tax allowable depreciation only on the 700 million, not the entire investment. Colvin Company's finance director believes that the plant and machinery will have a zero residual value at the end of 4 years. So the scrap or salvage is zero. But the land and building will get disposed of at the end of the project, and their tax exempt value is expected to increase at an annual rate of 30% throughout the 4-year life of the investment. So they are expecting this land to appreciate by 30% year on year for the next 4 years. Okay, and then they can sell that land and make more money out of it, right? The project will also require an immediate investment in the working capital. So understand, two types of asset. One asset, depreciation is tax allowable. The other asset, no information about depreciation, so we are going to ignore that part. But they have said that salvage for land is going to increase, so it will be more than 75 million. It's increasing at a 30% rate, and in case of 25%, in case of machinery, there is no salvage. Okay, zero. And this 30% is tax exempt. Whenever you sell it, it's tax exempt, right? The project will also require an immediate investment in working capital of 25 million. So you have to invest in working capital as well, along with your fixed assets, that is land and machinery. The annual incremental working capital requirements are as expected. So in year zero, you are kind of investing. Now, remember, this is incremental working capital. So you need not, this is not your requirement that you need $2.5 million. This is the additional you have invested. So in year zero, you have invested 25 million. In year one, you are additionally, incrementally investing 2.5 million. In year two, 2.8 million. In year three, 3 million. At the end, you will release all of this. Okay, you will release 33.3. Anyways, we'll come to it, but this is the meaning. Okay, the word incremental is important. Working capital will be released back in full at the end of the project. Even if not mentioned, we assume that. Colvin has a policy of extracting remittable cash flows as dividends at the earliest possible opportunity. So immediately you will transfer whatever profits are earned at Calvin or Colvin country, or whatever the country's name is. Colvin. Canvia country. Okay. So all this is in Canvia. Calvian lira. Okay. Calvinian lira $1 million. These are all CL $1 million. Okay. Annual again. Canvian lira million. Working capital will be, we read that. All components for the new bicycle will be produced or purchased in Canvia, except for a gearing system component, which will be manufactured by Colvin company in Eurozone. The cost of acquiring this component from the Eurozone is already included in the pre-tax contribution estimate. So when we are looking at contributions, it was sales minus variable cost. So in that variable cost, this component, along with other local components being purchased, your raw material or cost, is being already included. So you need not separately take it for Canvia. Okay. The cost of acquiring this component from Eurozone is already included based on transfer price of 10 euros per component. So the transfer price taken is 10 euros. Finance director estimates a manufacturing cost of £2 per component. Why is this given in pound? Is that a typo? I think it's a typo. It should be 2 euros, not pounds. We'll see. I think this is 2 euros because we are manufacturing in the EU, and transfer price is 10 euros. So this will also be 2 euros per component. So basically, for the parent company, they are manufacturing this particular component for 2 euros and they are selling it for 10 euros to their subsidiary in Canvia. Okay, both the transfer price and the manufacturing costs are expected to increase in line with Eurozone annual inflation rate of 4% in the first 2 years of the project and 2% in year 3 and 4. So this is more possible that yes, inflation rates are changing. This seems more practical. Then moving on, corporate corporate tax in Canvia is payable annually at 25%, and companies are allowed to carry forward losses to offset against future trading profits. So you can carry forward losses if you incur losses. Colvin pays corporate tax in its home country at an annual rate of 20%. Now, since it has already paid 25%, and in the home country it is 20%. Now let us see if they have any treaty in place which can set this tax off. Otherwise, it would have to pay 25% in Canvia and 20% in Eurozone. Okay. Taxes are payable in both countries in the year of the liability is incurred. So there is no lag, or there is no delay. Taxes are not paid in arrears, basically. A bilateral tax treaty already exists between the two countries, which permits the offset of overseas tax against any domestic tax liability incurred on an overseas earning. So this 25, now since you have already paid 25% tax, you need not pay any additional tax on those profits when you get it in Eurozone. Exhibit 3, the board proposes financing the project with a mix of equity and debt in such a way that the existing capital structure remains unchanged. For the purpose of the project, the chief executive believes Colvin Company's WACC is 13% should be adjusted to include a country risk premium on the basis that Canvia is a developing country and appears to be economically less stable than the Eurozone countries. She made this decision after consulting a country risk index, which compares the standard deviation of market returns in various countries. Okay. Um, Additional factors taken into consideration include foreign exchange risk, the fact that there have been frequent changes of the government and hence economic policies in Canvia. You have therefore been asked to use the discount rate of 16% to appraise this investment project. Okay, so here there are two WACs, right? See, understand that from strictly from a CAPM point of view, we look at beta, right? And see, whenever we talk about WACC, we look at cost of equity, cost of debt, and all of that. But now here we don't have enough information of cost of equity, cost of debt, beta. All those things are not given to you. Okay, they have straight off given you the WACC for Colvin. Now, the WACC of 13%, where that beta is there, is already considering all the risks. Okay, and here now they are saying that there are further risks that because there is country risk and all of that. Why is there country risk? There is some change in government, like frequent change in government, economic policies, uh, all of that, foreign exchange fluctuation. For all these reasons, they feel that the risk is more and it should be discounted at 16% and not 13%. Okay, so that was the part B, is it justified that we use 16%? Okay, but if you look at CAPM, okay, it already considers risks. Okay, it already considers the market risk. So it has already considered the market risk of Canvia. Okay. Now, question 1. So our typical format begins. So the moment you realize that it's question on NPV, you will start off sales minus costs. Your variable cost will give you contribution minus your fixed cost. Okay, minus your tax allowable depreciation will give you your profits. Okay, then you will put taxes on those profits. Then you will add back the tax allowable depreciation. If you don't want to do minus tax allowable depreciation and add back tax allowable depreciation, then you calculate savings on TAD. Okay, and include that only. Okay, then you take your initial investments, scrap value, working capital. So you just prepare that pro forma. Now over here, um, sales minus variable cost is already given to you. Right, so pre-tax contribution is already given. Let me just check if I'm not covering anything. Yeah, okay. This is already given to you. So pre-tax contribution is already given, fixed cost is already given. Now depreciation you need to calculate. Okay, so we know that it is 25% SLM basis, right? So 700 is the value of the asset. Okay, the plant and machinery, only on that we are calculating depreciation. So 700 into 0.25. Oops, sorry, 700 into 0.25 is equal to 175, and it remains the same. It's straight line basis, so it keeps, the depreciation doesn't keep changing, SLM base. Okay, therefore your profit after depreciation, you could also call it EBITDA, EBIT. Okay, Anyways, we'll just call it profits after depreciation. Okay. Uh, is nothing. You just take your contributions minus fixed costs minus your TAD, right? Then you will get your so you realize that in year one you are making a loss. Okay. Now, typically in countries, losses are not allowed to be carried forward, but this particular question, they have explicitly mentioned that you can carry this forward. So what you will say that we are going to carry forward this loss. So my profit will be 0. Okay. And I carry forward this to the next year. So next year I earn a $34 million profit. That profit will get reduced by 26 million and become only 8. So my next year's profit will not be 34 million, will be 8 million. Okay, just keep that in mind. Losses carry forward. This is an interesting adjustment that I don't know, a lot of students don't know how to carry forward losses, because typically whatever questions we have done is majorly no carry forward of losses. But in this is a question from one of the mocks, I believe, or past paper. I don't recollect where I got this question from, but it has come up. It's from the ACCA's official resource. I have picked this up. Okay. So there was a question where losses were carried forward, and this is how you carry forward it. So in this particular year, you are going to reduce those losses. So it nullifies the loss. Okay. And the same loss, you are going to carry it forward in the next year, year two. Okay. So year two's profit reduces. Right. Then you find your taxable profit. So till year, everything was easy. Okay. Once you find your taxable profits, then you have to reduce taxes. Now year year one, there is no tax at all. Okay, because the profits are 0. From year two, though profits have reduced, but you have to pay tax. Now keep in mind, you are in Canvia, you are finding the NPV of the Canvia business. Okay, so the tax rate of Canvia will apply. Just write it in brackets. This is just for you to understand. See, whatever I'm writing, so much disclosure is just so that you understand what is being done. So 25%. All right. Just checking. Yes, everything is proper. And then we add back depreciation. What we reduced initially gets added back once tax is done. Tax is paid. Okay. And we also add back the carried forward losses, because see, it's a loss. Cash has flown out. It's a cash flow loss. Cash has ultimately flown out. You only did this adjustment for tax purposes. Okay, so this needs to be added back. Keep in mind, I'm just going to highlight this. Okay, so that you recollect this. Okay, that you have to add it back. Right? Then you arrive at your final cash flows, to which these are cash flow from operations, you could say. Then you have your investing activity. So you are investing 775, that's 700 million, plus 75 million in land. Now 75 million in land keeps increasing at 30%. Okay, so it's 1 plus 30%, so 75, 1 plus 30%, and it's increasing year on year. So raised to the number of year, that is 4th year. Okay, so raised to 4. Right? So 75 into 1 plus 30% raised to 4 years will give you 214. So the value of 75 million got increased. So if you had to manually do it, what is happening is it was 75 year, then you are doing 1 plus, what was the growth rate? Sorry, 1 plus 30%, right? Okay, so you see it grows to 214. It was $75 million today. Then with 30% growth year on year. So over here, I did not do raise to or anything, because I took the previous one as the base. So it's already inflated by 3 years. as in it has already grown, the price has grown by 3 years, and then I'm adding another 30% to it. But the shorter way of doing it is like this. Okay, raised to the year, right? So then working capital investment was also given. So it was, honestly, it was a pretty simple NPV question. Okay, but this is an international NPV. So you find your net remittable cash flow, which is going to be paid. You could call it net remittable cash flow to be transferred as dividends to parent company in euro. Okay. So this is that cash flow. So we could just, in fact, we could just highlight this. So this is what we are going to transfer, right? Now this getting transferred. So it now, whenever we transfer it, we will have to exchange because all these profits are in Canvia Lira, CL million. Okay, Canvia Lira million. We have to convert it into euro. For that, we need an exchange rate. Now, so working note number 1, see how we have labeled it. See over here, we need not have appendix because we are not writing a report. Okay, we can just say that working note 1. So your exchange rate, I have referred to working note 1. So what is working note number 1? Exchange rate. So how are we calculating it? We have the inflation of Canvia, happens to be 10% throughout, flat, questionable, and inflation of Eurozone, which is 4% for the first 2 years and 2% for the next 2 years. Okay, which is practical. And then we find the rate. Now 9.91 is already given using IRPT. Again, the formula is given in the formula sheet. So is equal to the current exchange rate into 1 plus the inflation at counter currency divided by 1 plus the inflation at home currency. Okay, or base currency, right? So inflation rate at base currency is 4%, so that will be in your denominator, whereas counter currency is Canvia, so that will be in your numerator. So since we know that we are a Eurozone based company, we know that it is being transferred to euro. We understand rather that the base currency is euro, right? Therefore, the base country inflation will be Eurozone's inflation. With that, we are forecasting or estimating exchange rates for year 1, year 2, year 3, year 4. Now, based on this exchange rate, we are transferring money. So now in year 0, it is an investment, right? It is an outflow of 800. So that translates into, so we are converting that 800 CL million into euro million, right? So gets converted to 80.7 million euros. That's an outflow. And then there are inflow. So year 1, there is an outflow. Rest afterwards, year 0, there is an outflow. And then afterwards, there is inflows. Okay, so total investment, outflow. And then remittable cash flow as dividends is inflow. Okay, so we calculated all the inflow. Now, beyond this, there is something they spoke about, transfer pricing. Okay, as in like certain component is exported by this European company to the subsidiary. So they are selling certain component, and to manufacture that component, there is a cost. So sales minus cost is contribution. So we have written the contribution over here. Now, how do we find that contribution? Working note number 2. Okay, so it's very simple. When the paper checker sees, like if you just look at this, wait, let me just see if my head is covering anything. No. Okay, now if you just happen to see this, say in 100% view, it is clean. You know, okay, this is something important. This is something important. These are certain important final answer rather. Okay, headings are given. What is this heading? Okay, you could in fact highlight this also if you want, that this is the NPV of the euro project. You are leaving a line between these two. Could probably leave two lines. So we understand, okay, this is one block, this is the other block, this is another block. Okay, let me zoom in again. Right, so this is how you are to present clarity of information given. You are properly saying what are these figures, this is investment, this is the cash flow, dividend received. Just writing in short for now, okay, for your understanding, right? Then component contribution working note 2. So what is it? Well, we know that the sales volume were given to us. Okay, now we are transferring it at 10 euros, and the manufacturing of it. Now this is available from here. Okay, 109, 121, so on and so forth. Okay, sales volume was given, so that sales volume remains that. Okay, so to produce one cycle, okay, like that, we are selling how many cycles? 109,000 cycles, right? And that particular component is costing, or we are selling it for 10 euros. And how much is it costing us to manufacture it? It's costing us 2 euros. So the contribution is 8 euros, but there is inflation. Okay, so inflation is going to impact both your cost as well as your sales. Okay, so we are doing like a combined inflation on contribution only. Okay, so inflating at 4%, so raised to 1, then this is raised to 2, you could say, in fact. So either you could write it this way, or alternatively you could do raised to 1 that way as well. So you could just take $8. Actually, you couldn't do that because the inflation rate changes. Okay, so yeah, you can't really do raised to 2, raised to 3 because the inflation rate changes. Okay, so you will have to do it this way only. So year 1 rate is 8.3, or year 1's contribution is 8.3. Then taking that contribution, you are further inflating 4%. Okay, then taking that inflation as the base, you are further inflating it by 2%, and then another 2%. So just keep this calculation in mind. Okay, this is slightly different because we are used to just doing raised to 1, raised to 2, raised to 3, raised to 4. Because over there, the inflation rate was fixed. Here, the inflation rate changes. Right? So we have to take the base and then inflate it. So therefore, we now know the contribution. So the total contribution will be sales into contribution per unit. These are all per unit prices. Okay, so total contribution is this much. Now in our answer, the main table, we are taking everything in euro million. Okay, but this is in the entire amount. So $912,000, which is $9.9 million. So we do divide by $1 million. So that is 0.9. Okay, that's how we arrive at it. Okay, so we write the component contribution is this much. We get it from there. Now we have to pay tax only on this contribution, because understand, on this remitted cash flow, we have already paid 25% tax. Contribution is nothing like a gross profit, basically gross profit, sales minus variable cost. Okay, so net cash flow, tax that you pay on that profit only will be 20%. This will be UK tax. Okay, so keep in mind, it is only and only on the contribution that you are paying. Okay, so keep that in mind. This is another thing one could forget. So let me just highlight it for you. How did I highlight? Yeah, I just highlighted the line item. So keep this another thing in mind. Okay, only on that component. Otherwise, a common mistake would be, okay, just take component contribution and forget about the tax. They just miss out because they are in a hurry. Right? So taxes have been reduced, and then you arrive at your final cash flow. And then you find NPV at both 16 and 13%. So at 16%, if you have to find, is equal to NPV, bracket open. Now in exam, you won't be given a guide like, see over here, it immediately appears, you need the discounting rate. Okay, but you need to know how to use these formulas. So NPV, bracket open, discount rate. So discount rate is 16%. Okay, comma, cash flows. Now cash flow always and always from year one onwards only. So you take cash flow from year one, shift, arrow, 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 right arrow, right arrow, right arrow. Why? Because you have to, it's like a combined selection. You want to select more than one cells. So you will press shift and then arrow, arrow, arrow. Okay, this is your present value, bracket close. But you haven't taken year zero. Why haven't you taken year zero? Because it is already in present value. So you are not discounting it at 16%. You are only discounting from year one onwards. However, in NPV, we have to take year zero. So we are doing less year zero. Okay, now the year zero is already given as a negative figure. So I'm putting a plus sign and then plus minus is equal to minus. Okay, so that's how I'm arriving at 3.3. Now this same formula, I can just copy it, okay, and paste it over here, and I'm getting 3.3, okay. But the discounting rate changes. It shouldn't be 16, so I'm just changing the discounting rate 13%, and I'm getting 2.85. Okay, this is how you can calculate the NPV. Right? In fact, the cash flows can be made in bold because these are the final cash flows. Okay, and then you are finding the NPV based on those cash flows. Right, so as per 16%, the cash flow, the NPV is negative, and as per 13%, the cash flow is positive, or NPV is positive. Okay, so we can conclude the decision whether to, okay, I will have to, yeah, my head is covering it, so let me just minimize it. Okay, this is too small. Okay, little bit coverage. Yeah, okay, better. Okay, so the decision whether to accept or reject the project critically depends on the discount rates, obviously, because that's the cost of capital. What is the discounting rate? It's nothing but the cost of capital. Okay, if your cost of capital is more, the project return will be less. Okay, so critically depends on the discount rate, switching from a negative NPV of 3.3 million when the discount rate includes country risk premium to a positive NPV of 2.8 million when there is no country risk premium. This adjustment to the WACC requires further investigation because it is possible that Colvin could reject the project could reject a project that increases shareholders' wealth. So part B is anyways asking us to look into this further. So we have just writing this comment that listen, because if you see the question just asks us to, what is the requirement? Evaluate. Okay, so we have to give a decision also. Evaluate the suitability of investment proposal, uh, including the impact of country risk premium. Okay, so we are saying that with the country risk, it is negative. Without country risk, it is positive. But we will have to evaluate which WACC to be taken, because otherwise, if we reject this project, then we could possibly be rejecting a project that could potentially actually increase shareholder wealth, because any positive NPV project increases shareholders' wealth. The outcome assumes the contribution and other cash flows are reliably estimated. So this is one assumption that we are making, which needs to be highlighted for your professional marks. The outcome assumes that the contribution and other cash flows are reliably estimated. Other critical inputs include the assumption of land and building will increase at an annual rate of 30% and that any disposal is tax exempt. We are highlighting the major assumptions that we are making. Okay. Again, you could add that skepticism mark also, that also note that in real world, the a constant inflation rate as given for Canvia may not be practical. Okay, you can give that line also. Now, solution 1B. So you have kind of evaluated both, that if it is negative, then 3 points, it will be rejected. If it is positive, you will accept it, but that depends on whether to take country risk premium or not. Now we are discussing that there are a number of possible strategies to avoid exchange controls on remittances. Colvin Company could increase transfer price paid by Canvia subsidiary for the gearing system component. This would increase the profit to the detriment of the subsidiary's profit. Okay, so the parent will profit more when the prices will increase and the subsidiary will have more expense. Okay, alternatively, Colvin doesn't currently levy a management charge or royalty, but if these were introduced, it would transfer profit from the subsidiary without the need for a dividend. These methods assume that exchange control imposed in Canvia are not applied to repatriation in general. And alternatives would be for Colvin Company subsidiary to make a loan to Canvia subsidiary to another Eurozone based parent company. Wait, am I covering these? No. Okay. Parent company, which in return would lend an equivalent amount in euros to Colvin Company. The same objective would be achieved with currency swap through counterparty risk would be a factor in both cases. So it's trying to explain, we are explaining, see, the director has highlighted certain risks, that why are they levying a country premium? Because, okay, firstly, consulting whom? They consulted a country risk index, okay, and which measured the standard deviation. And what are the additional factors taken into consideration? Foreign exchange risk. So we are talking about that foreign exchange risk is managed. How? We discussed that. Then change in government, economic policy. So all these points we need to discuss. Okay, these methods assume that, yeah, okay, so that's your exchange rate. Now, Colvin Company's investment in Canvia does not involve a change in business risk or capital structure. So your beta essentially doesn't change. Your business risk is not changing. Your financial risk is not changing. The company's WACC would normally be expected to provide a reasonable measure of risk of the new project. The chief executive's justification for a risk premium is based on the increased risk of company is exposed to in Canvia, which is a developing economy compared to the company's existing business in the Eurozone. This perception of increased risk is based on a country risk index, which compares the standard deviation of market indices around the world. The chief executive has incorporated other factors such as political risk, foreign exchange risk in determining this premium. However, standard deviation is not the appropriate measure of risk for Colvin Company's investment, since any portion of total risk that is uncorrelated across different markets can be diversified. Standard deviation is a measure of unsystematic risk. Okay, at no cost to the investors. For example, adverse political events in Canvia may be partially offset by more favorable events in other part of the country or the world. No rational investors would pay a premium for risk that can be avoided. In this sense, although Colvin Company's investment in Canvia is exposed to foreign exchange risk, this too can be mitigated by an appropriate hedging policy. Furthermore, Colvin Company is institutional. So you have to see whether that risk is diversifiable or not. If yes, it is diversifiable. So whatever political risk, we can diversify. Foreign exchange risk, we can diversify. Okay. We can manage these risks. So we will manage those risks. Furthermore, Colvin Company's institutional shareholders are already likely to be well diversified global market. So they have already invested in different countries. The potential for further risk reduction by Colvin Company Firm diversifying global operations globally is therefore limited when the shareholders can achieve this more efficiently on their own. So Colvin Company at the company level need not even do all these hedging or risk management because the owners have already diversified at their level because it's a listed company, institutional holders majority. The only component of total risk that could justify a premium to Colvin Company's cost of capital is market risk or the undiversifiable risk. This assumes returns from countries are significantly positively correlated. For example, there is a strong possibility that a recession in Eurozone may also lead to a downturn in Canvia, uh, too, rather than to offset it. Okay, so Canvia may not offset it, it may also lead into or get into recession, transmitted through trade links and closer integration between the markets. This tendency for the market across the world to move together means reduce risk reduction benefit from diversification, hence a higher cost of capital. The key issue, therefore, is whether the risk of new investment is diversifiable or not. If returns across the markets are significantly positively correlated and the risk is undiversifiable, the new project in Canvia may therefore command a risk premium, although no justification is provided from the chief executive's premium of 3% would require further investigation and analysis. So here you have identified missing information. You are saying and you are giving a balanced judgment. See, this is how a professional will give their views. There is no straight right or left. Okay. They are saying that, listen, country risk premium, when will we add it? When there is undiversifiable risk. Now, he has given certain parameters, out of which political risk we can diversify. We can diversify financial risk. But what we cannot diversify is any country specific internally. Okay. Inflation changes or interest rate changes, which are very much practical. Okay. These are systematic risk. We cannot diversify it. Okay, so that needs to be considered. Now we are taking a beta of our own country. So we don't know. Maybe it gets transferred, maybe it doesn't get transferred. We can't say anything now. Okay, so we are saying that we need more information. So the 3% premium, if you can justify it, is to compensate for the systematic risk, then yes, take it. But if it is to compensate for political risk, for foreign exchange risk, then we cannot take it. Okay, so that is our conclusion. That is how we have discussed it. So we have highlighted practicality over here. We are talking about our assumptions. We are talking about uh, being a skeptic that it may not be possible. We are talking about missing information. All right. So all these things we are talking about. Now, I know we are extending, but I wanted to do two questions. So we will do these two questions. Okay. Probably tomorrow we would cut short the explanation part or maybe even skip it because I got this feedback when I was taking FM. You let me know. Okay, do you really need these explanations? Because we have already done it in class and I'm sure you have already studied all these things. I think a better strategy would be spending more time in question solving rather than explanation. Okay, so anyways, we will do the second question very quickly. Um, the question is calculate the APV of investment and recommend whether the project should be accepted or not, and discuss the factors the capital providers, including the bank, will consider before deciding whether to approve the funding decision for Robson Company in a new manufacturing plant. Okay, so APV, that means base case NPV, and then adding the financial side effects to it. Uh, APV is done when we cannot use the historical WACC because the capital structure of the company is changing and also the business risk may be changing. Okay, so let's read the question first. So we know at least that it's relating to APV. Robson Company is, so there is 14 marks for calculation and the balance 11 marks for theory. Now, this is an old style of question, so you don't see professional marks over here, but in your exam, you will be having a 5-mark professional also. So it won't be a complete 25-mark question. Okay. Anyways, let's quickly read. Robson Company is a food manufacturer with a portfolio of well-known brands. The founding directors retain a significant minority shareholding in the company and continue to serve on the board following a successful listing 10 years ago. So the founders own a minority. It is a listed company. After obtaining the listing, Robson Company's gearing ratio increased significantly above the sector average as a result of poorly timed expansion strategy, mainly financed by debt. So, which kind of tells you that the financial risk is above market average. Earnings become increasingly volatile, um, and the debt burden triggered a decline in company's financial performance. The board responded to these problems 5 years ago by pursuing a debt reduction turnaround strategy, which has been financed by a series of right issues and asset disposal. So the company has recognized the problems of financial risk, and they are reducing debt by, or they are improving their capital structure by issuing more equity and also selling off assets to pay off debt. Even though the strategy successfully reduced their gearing ratio, which is now equal to the industry average, so we are at par with the industry now. From financial risk point of view, the share price remains to be depressed due to competitive pressure within the industry. The company's credit rating has recently been downgraded once again, and Robson Company's chief executive officer has identified an opportunity to relocate the manufacturing plant and develop a state-of-the-art automated production line, which will reduce the underlying cost base and be a source of competitive advantage. Okay, so for due to competitive pressures, their share price is not going up, and to add to it, for some reason which we are not sure, the rating has been downgraded despite our debt to equity level rising, possibly because they are suspecting that the earnings are too volatile and they are not sustainable, and therefore the credit rating agency may be a little skeptical as to whether this company would be able to pay its interest obligation and has downgraded the company further. Now, the CEO has identified a new to make a new plant elsewhere, relocate it. Okay, so that the costs reduces and the margins improve, and it will get a competitive advantage that way. Robson Company's financial director has prepared estimates of free cash flows generated. So FCFs have been, we can use this for our base case NPV. So free cash flows generated are these. So this is after sales, expense, everything, okay, over a 4-year horizon for the project. The investment cost is $120 million. So year zero outflow will be 120. Disposal of existing manufacturing plant, you are selling for 20. Sorry, the investment is 120 million, which is being proposed to be financed as following. So you need 120 million, that is year zero outflow, but how are you arranging for this 120? By selling off certain existing, since you are relocating, right? So the old plant and machinery, you are selling it off for 20 million, you are raising a part equity by 10 million, subsidized loan of 40 million and bank loan of 50 million. Now, subsidized loan is available at 3.5%. We don't necessarily know why are we getting a 3.5% subsidized loan. So that we can question, okay, that it is given that 3.5% is receivable, but the company doesn't seem to be doing anything in any, we're not sure what sector they are. It's a food manufacturing company, so why are they getting a subsidy? Possibly they are setting up a plant in an area like in India, we have special economic zones. So probably they are investing, or they are setting up their factory in a area which the government wants to develop, and therefore the government is giving this sort of subsidy. So location of this plant is pretty crucial for this project, okay, to enjoy this 3.5% subsidized loan. Okay, anyways, this is how the funding is done. Bank loan is repayable in equal annual installments. So it's like a EMI. It's not interest. It is fixed amount. So keep in mind the tax benefit is only on interest component. So you need to figure that out. Okay. You have to take the interest component separately, calculate tax benefit only on that component, not on the entire amount payable. Okay. Though the entire amount will be a cash flow, but tax benefit only on interest part. So how EMIs work is partial is interest and partial is principal repayment. Okay, your typically what we are used to doing is interest, and then principal at the very end. But here it is a mix, a combination of interest and principal repayment. Okay, so the bank loan is repayable in equal annual installments over 4 years. The issue costs of 2% are payable on gross external financing and are not allowable for corporate taxes. Issue costs are payable out of available cash reserves. The finance director has asked you to ignore underwriting costs relating to right issue. So that needs to be ignored. And issue costs have been given at on gross external financing and are not allowable for corporate taxes. Okay, issue costs are payable out of cash reserves. Now, Robson Company's current equity beta is 1.418 and the debt equity ratio is 1:5. The risk-free rate is 3% and market premium is 9%. The CEO expects the business risk of the company to remain unchanged as a result of the investment. Corporate tax is 20%. Okay, so we have our own equity beta, but we cannot use it because our capital structure is going to change. And the debt to equity of the market is given. Market beta is available to us 1:5. Risk-free rate is 3%. Market premium is 9%. Okay, and business risk of the company remains unchanged. So business risk is remaining unchanged. So we need not because we continue to be in the same business. So business risk does not change. So we need not take a proxy beta per se. Okay, all we are doing is we are doing APV, wherein our capital structure is changing. Therefore, the financial side effects we are looking at it separately, and NPV, base case NPV, we are calculating separately. Now, for base case NPV, we do not require equity beta. We require asset beta, right? A beta as if assuming that it's an all equity finance zero debt company. So we have the current equity beta, we have the debt to equity ratio. We also know that the business risk is not changing, so we can use this old equity beta and we are ungearing it. Okay, so we take this beta, we ungear it using the formula and get the discounting rate, which happens to be 14%. So how do we calculate? If you see working note number 1, asset beta. So we start off with equity beta. This is the formula, okay, for ungearing. So asset beta is equal to 1.22. All right, which is beta equity into market value of equity, that is 1:5 was debt to equity. So 5 will be in the numerator, and in the denominator it is 5 plus 1 into 1 minus t, that is 80%. Okay, so 20% is t tax. So we arrive at asset beta, then we use this asset beta in the cost of equity and get our cost of equity. Cost of equity as if it is an zero debt company. Therefore, we could have used beta asset. So 14% is our discounting rate. Free cash flows were already given. Now we just discounted at 14% using a formula. Remember, we take cash flows only and only from year 1 onwards. Okay, wait, let me just zoom this in because I think I'm not covering anything, right? Yeah. Okay. So was I? Yeah. We were looking at NPV. Once we arrive at 14%, cash flows are already given to us, and we discount those cash flows from year 1 onwards, and we arrive at our NPV. Okay, so we know our base case NPV is 4.5 million negative. So if it is an all equity finance company, then we are going to reject this project because it is not financially viable. Okay. So financing side effects. Now we look at different financing side effects. So we have issue costs. Okay, we are issuing right right shares. Okay, so let's look at issue costs. So gross funding that we are doing is 100 million. How are we getting 100 million? Because asset was sold. So other than that, everything is issued. We are issuing rights, we are issuing subsidized loan, we are issuing bank loan. So our what we are issuing is $100 million. Now this is issue cost of 2% are payable on gross external financing. So this is already our gross value. Okay, so 2% on that is what we are paying as issue cost. So 2% on that. Note that issue costs are payable out of cash reserves, so the finance does not need to be grossed up. Okay, so $2 million is the outflow that we are having, right? And then moving on to the next component, that is PV of the tax shield. Now that we are going to calculate for subsidized loan separately and separately for bank loan. Okay, because subsidized loan is your regular, bank loan is the EMI style. So for subsidized loan, you know that you have taken a loan of how much? $40 million. On this $40 million, you are paying a 3.5% interest. So your interest component is 1.4 million. Okay, and you are enjoying tax benefit on it. That is annuity factor for see, every year you are going to enjoy the same benefit. Okay, so you can just find annuity factor, or else you can discount it individually for all 4 years. You will get the same answer. Either way, it would work. Okay, so you are discounting it using annuity factor for 4 years at the rate of 9%. Now, 9%, not at 3.5%. So always remember, the discounting rate will be at normal bank loan rate, or we can use it as risk-free rate. Anything would work. Okay, and it will be pre-tax, not post-tax. Okay, pre-tax rate. Why? Because we are looking at the tax shield. So tax is being considered separately, right? So we will take pre-tax rate. We are discounting with normal pre-tax. For discounting. Okay, I think this is covered. I'll just move. Yeah, so it's for discounting. So you read that. Okay. So, or else, wait, let me just fix that for you. Okay, clear? So, PV of the tax shield, very simple. What is the interest? What is the tax relief that you will get? Now, what you are doing is you are calculating the interest into the tax relief. That is 20% is you are going to enjoy as relief. And now you are finding the present value. So you will multiply that 0.3 into the annuity factor. You are discounting it to arrive at the present value. So present value of the tax shield on the subsidized loan is 0.9 million. So that you are taking separately. Okay, 0.9 million. That is a benefit. Okay, that you are enjoying. And then bank loan. Now for bank loan, you need to find the interest element. So firstly, you are finding what is your annual installment that you are paying. So for that, you will take the entire loan amount, that is $50 million, and divide it by the annuity factor. Okay, which happens to be 3.24. Okay, that is how. So I'll just, let's say, N. Okay, so it is basically your annual payment is equal to your or annuity, you could call it, is equal to loan amount or loan amount taken divided by your what do you say, annuity factor. Okay, what rate at pre-tax? Okay, so we are taking that annuity factor at the same 9%. Okay, so this is how we calculate the annual repayment or the annuity. Now from that totally, so what is happening is totally we are paying 15.43. Now one more thing to keep in mind is, see, those figures are gross figures, as in we need only 50 million loan. We are not adding the issue cost in it. Okay, that is including issue cost already, right? So 50 million is the loan that we are taking. Annual repayment after year one is 15.4. That means how much interest are we paying on 50 million loan? 9% interest is 4.5 million. Okay, that means how much principal we are paying? Totally we are paying 15.4, out of which 4.5 is the interest component. That means 10.9 is the principal repayment. So how much principal is left to be repaid? That is 39.1, which happens to be the opening balance of year two. Okay, so on and so forth, right? And we are just calculating tax on the interest element. So once we know the interest part, we are calculating tax relief on it. Okay, and then PV of the tax shield is, you will add up all of these and then discount it at 9%. Okay, 9% as in the bank loan rate, pre-tax. Right, clear? So present value of this tax shield. So for tax shield, you need interest. This is how you are finding the interest. Okay, for interest, you need to know what the opening balance is. All right, so now next year, let me explain about year two. So now in year two, only 39 million needs to be repaid, but you are still paying 15 million. That means 3.5 is the interest component, balance is principal repaid. Okay, therefore, net your principal to be repaid is 27 million, which becomes the opening, so on and so forth. And towards the end, your principal repayment is zero. So technically, by paying partial principal at the end of year four, you have repaid the entire principal also. And these are the interest, sorry, these are the interest that you have paid. Okay, then you discount it and you find out the tax relief on this over here by multiplying with the tax rate, and you will find the present value. And this present value, you need to put it up over here. It's 1.98, so it's almost $2 million. Then you need to add the present value of subsidized loan benefit. Sorry, you need to add the PV of, that was a timer for my other session, but this just got extended. Anyways, let's just quickly do this. Um, so you have your present value of subsidized loan that you need to calculate. So let's quickly do that. Very simple. Subsidized loan benefit. So what is the benefit that you enjoy since you have taken this loan? So the benefit that you enjoy is, normally you would have to pay 9% interest, but now you have to pay 3.5. Okay, so the benefit is the difference between these two interest rates. Okay, now since it is taxes are paid in area, since taxes are paid immediately, so we can directly do this 1 minus t. Otherwise, it would have been in arrears and then we had to take it separately, wherein individual years we would have to calculate benefit, interest benefit, and the tax shield would be in a 1 year lag. Okay, I hope you remember that adjustment, how it's done. So it's like you would have taken loan benefit over here. So it would be whatever 9 minus 3, whatever, say 9 minus 3, whatever it is. So year 1, 2, 3, 4. Okay. And then you would have taken a 1 year delay, 1 year lag on the interest. Okay, sorry, not on interest, on tax benefits. Okay, tax shield, right? So your tax shield will come from here. Okay, and accordingly, discounting will also be different. You wouldn't be able to use annuity factor, but here we can use that annuity factor because it's in the same this thing, right? Because the tax benefit will get discounted at a different. It won't be discounted at year one rate, but here it's in the same thing. So it's you should be fortunate that it's given no arrears. Otherwise, it would have made your calculation more complex. Anyway, so you have the present value of your subsidized loan, which is where did we go? Yeah, 5.7 billion. Okay. So total financing side effects is 6.6. So to your base case NPV, if you add it up, okay, it's in fact over here we have already taken six. This is your so your total financial side effects would be sum of that was wrong. It's not 6.6. It will be just this much. Okay, 8.6 is your financial side effect benefits, and APV therefore. Sorry about that. APV therefore will be just $4.1 million. Okay, it will be this. Oh, sorry, I was correct. Okay, I thought this was our base case NPV, but here we are taking it separately. So 6.6 is our uh, total financial side effects, and then we are considering the base case NPV, which is a negative figure. So net net, it's a $2.1 million positive NPV. See, to be honest, 2.1 isn't that big, especially if you're investing something like $120 million. Okay, so you could write that in your, wait, let me just, okay, given the above estimates and calculations, APV of the project is financially viable, but do not write a conclusion just like this. Write that, don't write such a short one. Write something like, surprise is not written over here. Anyways, you can write that, please note that this decision would be provided if we are able to secure that subsidized loan, because the majority of the benefit that we are uh, uh, the majority of the financial side effects is positive majorly because of that subsidized loan. So if that subsidized loan is not availed, then this project is not worthwhile, because then in that case your APV will also be negative. Say for example, you take the entire loan using bank loans only, it won't be this much positive. Okay, our financial side effect is 6.6, out of which 5.7 is being contributed only because of subsidized loan. Okay, your bank loan would just get a small tax shield, which you have anyways considered over here. It will be slightly more. That's about it. Okay, so it's contingent. This decision is contingent or is based provided that you get that subsidized loan, which needs to be highlighted in your recommendation. Given the above estimates and calculation, the APV of the project is $2.07 million and thus is financially viable. Please note that this decision holds only if we are able to actually avail subsidized loans, as it is the major factor contributing towards the towards the positive NPV. Okay, so you can write something like that. This is a proper conclusion, right? And then from the view point of all the various stakeholders, well, you could just read through this. Okay, we don't really have the time. I have to rush towards my next class. So sorry for rushing through. Probably we'll skip with the explanations going ahead. Okay, we'll stick to only question solving. So thank you all for your time, or maybe we'll restrict that uh, explanation part. Let's see. Okay. So thank you all for your time. I hope you learned something new. I hope I was able to add value. I'll see you at the same time tomorrow, day 3. Today was day 2. Please watch day 1. Okay. All right. All the very best. See you all tomorrow. God bless you.